Hello, everyone. James Dobson here, and I'm bringing you the stats for the month of June. We are in July, but we covered the previous month's stats, so it's a bit of a lagging indicator. But I got some really cool stuff to unpack for you today, some more macro stuff. So it's going to be really interesting, so stay tuned to the end. All right, jumping right in, one of the first things that we can check out is a change in the benchmark rate, which essentially it changed from how we identify a property 15 years ago would be worth today, and they changed that to what is the average property worth today. So you can see that the old benchmark rate was in blue and the new in orange, and the takeaway is that it's more effective at measuring actual average price. So you can see at some points the old benchmark rate was lagging a lot, and the orange one is a lot tighter to the average price. So anyway, he just wants to accentuate here that by that metric, you would have actually lost a bit of equity as a homeowner if you measure it by this standard, which not a ton of people do, so I wouldn't worry about it. All right, going into the resale market, you can see we are in a bit of a decline from the peak in January, February. However, we are still up year over year, 5%. We are down 18% from the peak. Without getting too into the weeds, this 18% should be higher in order to maintain the same level of affordability. So what we're seeing right now is people who were buyers are starting to get priced out, and that's putting a lot of strain on the rental market. But again, prices are still up year over year on average. Keep that in mind. And that's for Toronto specifically. I don't believe that is true across Canada. Month over month change in the benchmark price. So you can see that for the first time in 5 years, our month over month change is negative pretty substantially. If we like the government wants us to be right around this level for the most part, their target is 2% inflation on a yearly basis. So they want properties bouncing between 2 and negative 2%, averaging 2% growth, ideally. So the one thing I would point out is here, these don't usually last forever or very long for that matter. Which sort of takes me into the next part, which is inventory, buyers versus sellers market. If we look over at Toronto Metro months of inventory, you can see we are just almost in a balanced market, meaning inventory is growing. Now, it's a bit of an odd situation because as inventory grows, usually prices will decline. But we also have to account for sales, which is this one, sales to new listings ratio. So the biggest concern right now is that a lot less is selling. The prices have moved a little bit, but the volume has changed dramatically. We went from a high in 2021 of 120% of the listings going on the market were getting sold, meaning inventory was shrinking. So you can see if this number is over 100%, it means we're losing inventory from the system. We drop down to 40%, putting us in buyer's market territory according to the sales to new list ratio. But you can see that because rates have jumped so aggressively and affordability has gotten worse, although we should be in a buyer's market, we're not seeing as many buyers, right? It's a bit of a tough situation. If we keep going down here, this is more benchmark stuff, not super important. Okay, Toronto Metro active listings. So you can see this one is a little bit more spread out. We hit all-time low inventory. It's not all-time, but it's a multi-decade low of inventory back in January. And you can see that this, I guess, downward spike corresponds to this peak in prices. So when we are very, very short inventory and there's people that need to be buying, it really does drive the price up. That being said, the price of money has gotten significantly more expensive. So what does that mean for people who have sold or need somewhere to live? but they can no longer be a buyer, which they were initially intending to be. Renters is my philosophy, at least. So you can see, going back to inactive listings, inventory has jumped back up, which is normal. I do expect that we're going to bounce around in this range again. I don't see anything out of the ordinary that would push us, into tons and tons of active listings. And sorry, active listings and inventory. I use them interchangeably. I don't see any reason. What we do know is not enough homes are being built, and there's a lot of population growth, which is pushing demand. And we're going to get into the population growth at the end, and some investment stuff, which is going to be nice. Terminated listings. So you can see a lot of listings getting terminated, and that's not unnormal. Part of that is just marketing. People will terminate the listings and then relist at a different price. So I wouldn't put too much emphasis on this chart. If we move into condos specifically, we can see sales to new listings is dropping and months of inventory is growing. As Alex so kindly pointed out here, both of these are signs that the market is weakening. I wouldn't say weakening, actually. I don't think that's a good word. I'd say it's shifting towards a buyer's market. Competition is getting reduced a little bit, not in rentals. But in terms of buyers and sellers, prices definitely have come down. For investors, it's an amazing time to get a good deal on a price or on a property. And if you were lucky enough to lock in a rate earlier, you're going to be in a very good spot. Sorry about that. Picking up where we left off. So just covering condos, we're noticing the same thing in resale, detached, semis, towns as we are in condos. Just seeing in general, sales to new listings decreasing pretty substantially, as in a lot more listings are being added than are being sold, which equates to our months of inventory growing, which is a great thing for buyers. Active inventory is building. So that's condo active listings. So you can see that's growing again, but we touched on that already. Toronto Metro condo prices, you'll notice is a very similar graph to the previous one that we looked at, which is just the whole market. We are still up year over year, and we're down month over month. All right, now for the the rental market. If we look at months of inventory first, you can see that we are around our all-time low of half a month of inventory, which is pretty unheard of for the resale market. We're usually around one is when it gets frantic. So you can see we are very much in landlords' territory here, which kind of balances out because landlords are having a pretty tough time, or at least new landlords with the higher rates. And we'll touch on that in a sec. So inventory, all-time lows. And you can see this. Here's our inventory and our price. And I just want to line things up for you. So this incredibly high spike in inventory was in COVID, right at the beginning. And you can see at that time, rents bottomed out. So this would have been January, probably March of 2020. We saw peak rental inventory, and from there, just started tapering all the way off until the low. Had some people move just to lock in a cheaper rent at this point. You can see that inventory has just dropped off a cliff. Like I mentioned before, I attribute this partially to a large segment of buyers becoming renters because they either didn't lock in their rate or they waited too long and then it expired. So yeah, I don't envy renters right now, unfortunately. All right, so now getting into some mortgage stuff. This is an interesting chart. This is just the rate of a variable versus a fixed mortgage. You'll notice that we have a pretty sizable gap here. He notes it's 1.6%, which is significantly higher than, basically the past 2 years. And I attribute that to, as rates rise, the variable rate sort of factors in where they think rates are going to be in the future. So they're essentially forecasting that rates are going to come back down as this rate is significantly lower than the fixed rate. Here we're just talking about probabilities of another hike during the next meeting, Bank of Canada meeting or the Fed meeting, whether if you're in the US. From what I'm hearing, we have a high likelihood, I think they're saying around 93%, that we're going to get a 0.75% increase in July. We'll see how that goes. Variable rate premium, not going to touch on that too much. This is interesting. It's a little bit of a confusing chart. But the idea is, if you were to renew your mortgage, what would the net cost be to you? And I think what he's trying to outline here is that if you're just renewing your mortgage now, you can renew it at similar cost to when you might have got it, which is fair. I mean, when you compare it to if you had renewed in 2021, you could have locked in that cheaper rate. Looking back, we always could have done something better. Fixed rates. All right. This is a really interesting chart. I don't like to freak people out. I just want to make everyone aware that I'm concerned about the direction affordability is heading for this province and this country. You can see affordability is measured by your mortgage payments as a percentage of median household income. We are not in a good spot here. Let's just put it that way. Obviously, incomes are rising a little bit because of inflation. Are they rising enough to keep up with the increased mortgage burden? No, not at all. Now, something to consider here is that this doesn't represent the market, because most of the products in Canada, your rate or the amount that you pay actually doesn't change very much. So if you're let me be clear. The payment that you make to the bank won't change. The payment that you're making to interest versus equity, that changes. Your principal versus interest. Meaning, if you're locked in at 4% and rates go up significantly, the bank's not going to change your payment. They're just going to allocate a lot more of it towards the interest as opposed to the principal. Meaning, you're paying the bank significantly more when rates go up. Now, if you're in a fixed, that's obvious. Your payment doesn't change. If you're in a variable, there's two types: adjustable rate, non-adjustable rate. Typical, and from my understanding, it depends a lot on the bank, but I'm not a mortgage broker. There's a lot of variable rates where your rate is variable, but your payment is fixed. Unless you have what's called an adjustable rate mortgage. In this case, your payment will change with interest rates. Something to consider. Okay, the reason I want to bring that up was the majority of people are going to be on a fixed or a non-adjustable rate variable mortgage. I think it's over like 70% of the population. So the idea that we are going to have a housing bubble collapse because people can't service the debt, I find it unlikely, or a low probability of that happening. I find this next chart super interesting as well. Investor cash flows. You can see min of fixed. Okay. Variable. So take this blue as variable and then orange is fixed. All this is accentuating is the huge decrease in cash flow to a new real estate investor entering the market right now, meaning cap rates are getting significantly worse. That being said, rents are coming up, which is a good thing for investors. However, they're not going up enough to offset the added debt burden cost from rates increasing. Now, I mentioned it's a great time to be a real estate investor earlier. Why did I say that? From a cash flow perspective, it's not great. If you're an all cash or a mostly cash investor, it's amazing because rates and prices are inversely correlated. The idea is the average person is buying with a mortgage. So if rates go up, the price of the home comes down and the monthly payment stays the same. Now, if you're an all cash buyer, you take out that mortgage component. So now you're just buying a property at a decreased price with an increased rent, which is a great spot to be. But now the next chart will show you the return. Oh no, sorry, not the next one. The return of here we go. The return of a condo cap rate, which is the cap rate is the return, so net income versus purchase price on a condo versus the 10-year bond yield. I know a lot of people are going to say, well, don't invest in condos. I get it. I actually like the fact that condos build in that maintenance cost because that's often excluded in a freehold calculation. So I like that. It makes it simple. You can see for the first time in over a decade that bond yields are now higher than your expected Toronto condo cap rate. That puts a lot of stress on real estate investors. And it makes them question, should I be buying real estate? Because now they have a risk-free investment, which is what they call bonds, just a risk-free, return-free risk. I'm kidding. Anyway, there's something to consider from an investor's point of view. To be a leveraged real estate investor is not what it used to be. To be a cash investor, still good business, I would say, and now is actually a great time to enter the market. If you want to talk more about that, I don't want to go into too much detail. I think I'm already a little bit over time from what I usually do. There's just a few more charts that I skipped over here that I want to touch on, which are the population stuff. So, first, construction is falling. That's bad. We could attribute it to more red tape, higher fees, and lowering purchase price. All reasons why developers might not want to build. Canada population growth, incredibly misrepresentative, I would say. A lot of the growth that we get is not actually people coming to Canada, it's people who are already living in Canada that get their permanent residency or citizenship. So it can skew a little bit. Those people would obviously already need a place to live. So will that skew the numbers? I think so. The other thing to note is net natural population increase through birth, through basically everything that's not immigration. All-time lows. People are leaving Ontario to go to other provinces at all-time highs, meaning more people are leaving Ontario than almost ever before, going back to the 80s. Just goes to show. And then, so despite our net natural population decreasing significantly, Ontario population growth is still positive. That's because we let in 350,000 to 400,000 new people into Canada every year, and half of them come to the GTA. So keep that in mind. Unemployment's at an all-time low. Nothing else is new. And that's it for today. So just to close, I don't want to freak anybody out. I know things can look a little bit not great right now, but all things considered, home prices are holding up very, very well. I'd say we're going to plateau, maybe decline a little bit further. I do expect rates to continue rising as long as we see inflation. The Bank of Canada's main priority is going to be getting inflation under control and maintaining a decent level of unemployment. Those are their two, not narratives, but goals, right? And the one tool that they have to do that with is interest rates. So as long as inflation keeps climbing, measured by CPI, we're probably going to continue to see rates climbing. And with that, I'll say thank you for watching. I know this one was a little bit longer than usual. If you have any questions, please do not hesitate to get in touch. Thanks.